if you have a W-2 job that has solid income, and you're looking to get into investing on your own, where you're going to buy your own assets and you need to take out leverage in order to do that, hold your W-2 income and that's that safety that the banks feel really good about as you transition into this. Like I would hold that literally, even if your job is like terrible, you don't like it anymore, keep it so that you can have that income that you can represent while you're applying for these different loan products, lending products, because it will make it so much easier.
So how has debt played a role for you guys? How have you managed to lean into leverage throughout this 5-year period? Tell us a little bit about what it would take for somebody to scale up. If you're starting at the launch pad, you want to get up in, into space. Where are we at as far as utilizing OPM for this to happen?
Yeah, so it's a great question and a good analogy that actually my team uses all the time, the kind of launch blast off escape velocity analogy. So when we first got started in the first, let's say 3 to 4 years of this business, it required a ton of resources and a lot of time. We had to dedicate tons of time into research and understanding all this, and a lot of time in the markets, driving around, understanding, a lot of time talking to bankers. How debt played an initial critical role in our business was we got a unsecured line of credit with a local credit union in the first market that we chose to invest in. Our investment thesis is inland growth markets. So we invest in secondary and primary cities that are experiencing huge population growth and rent growth because people are leaving the coasts and moving inland. So that's our investment thesis. Our first market was Spokane, Washington, which is seeing a lot of growth from Seattle, Portland, San Francisco, et cetera. People are moving in because it's cheaper. They can get, even hold the same job that they had in Seattle or San Fran, which has that big salary, buy a cheaper home, maybe even some investment properties and have a higher quality of life. So that was our investment thesis. And so we went to Spokane, which is also my hometown, and began building relationships with local bankers. And that started off with a credit union. This was, obviously 2017, 2018, a little bit of a different economic environment, but based upon our balance sheets, based upon my wife and my other business partners' experiences as chartered financial analysts on Wall Street, they were able to, and I guess kind of the overall pitch of our business to make impact in the communities that we invest in. That credit union saw us as an opportunity and gave us a $500,000 line of credit. That was what we used to buy our first asset in Spokane, which actually, well, I should say the first asset that we bought was with seller financing. So the owner wanted to carry a note, and they sold us the asset with that note because their main goal was cash flow. And they're like, well, if we can make $1,000 a month, I think it was like even like $950 a month, and give you guys the control and ownership of the asset, then we're happy. And we're like, awesome, we'll do that all day long. So our down payment was really low on that. We actually didn't even have any debt with any institutions. It was just from that seller. So actually, to your point, like that was a really interesting usage of leverage on our first deal. The second deal was propelled by that unsecured line of credit that we got. And the third.
Do you mind if I ask a couple of questions about that? Just because it relates well to our channel here, right? We talk a lot about these types of instruments. Tell me a little bit about that $500K, if you don't mind, if you remember, in fact, because I know this was some time ago. Was it? I'm sure it was personally guaranteed, right?
Yeah, it was personally guaranteed. It was unsecured. Okay. So, yeah.
So we've got, obviously, credit made a big impact for you guys there. I'm assuming you came into this proposition with a paper borrowing strength from a credibility work. Great. Yeah. So obviously you would recommend that people manage their borrowing strength well. I mean, we have to understand this is step one. If you're not paying your bills on time, if you're not able to show that you're somebody that repays your loans, you're going to have a much more difficult time building something organically than you could going out and getting access to what a phenomenal tool, $500,000 unsecured, not an easy tool generally to get for just the average person. Yet I'm also a little curious how much the networking and relationship development that you built with the credit union impacted your ability to get that. Of course, it sounds like, your wife and your partner's backgrounds certainly didn't hurt anything in that conversation. Yeah. How about the average person? Would you be able to walk into a credit union today or a bank today and actually develop that type of almost a preferential treatment. And that's kind of the old school way of banking. We used to be able to relate, build relationships. Now with the big boxers, especially, it's nearly impossible. You're just a number. They don't care about anything. Yeah. What would you say the relationship between, that networking and your ability to qualify was?
Yeah. So it was definitely important. We spent time, having coffees and lunches with the private banker at this credit union. And I would say first and foremost, we learned about credit unions from a local investor there who had done similar things. And, of course, there were other banks in that city, including national, chains. And the nationwide chains didn't have any interest in what we were doing. And even the local kind of regional banks didn't have any interest in doing what we were doing, or they did, but their rates were onerous and they needed secured lines. And we didn't have any income, by the way, because, we didn't have any W-2 income. We had that 1.5 year gap in between employment from, reputable companies and on Wall Street and what I was doing and what we were doing then.
So earning rents. You got this seller finance property, and you've got a condo you rented for a bit. And other than that, okay.
Yeah. They look at global incomes. They looked at all three of us and what income we were making from all the properties we had, or the very few properties that we had, like our place in Boston, my partner's triplex in Boston. They looked at that rent, but it really wasn't enough to make it happen. It ended up being, but it was also a combination of our own, persona. We kind of did a pitch on what our business was and what we were looking to do. And I was from that city. I went to, elementary school, middle school, and high school there. And I saw affordable housing as something that was needed. And we said, this is what we're doing. We're impact investing. We want to make an impact in this community, and in a very kind of small way. And because it was a credit union and because their mandates were to make an impact in the community and lend to locals in the community so that they can make an impact, that spoke directly to their mandates and their mission. So that would be, I guess, a takeaway tip is start with credit unions. Credit unions are great. They want to help the local homegrown folks that are there. They want to help invest in the backyard. In fact, we don't have that relationship with them anymore because we sold all of our assets in Washington State and redeployed into other markets. They won't extend us that line of credit anymore because we're out of their footprint, which just shows that they're very focused on, their footprint and making an impact there. So that's fine. We moved, we grew beyond needing to use them, but at that time, it was absolutely critical, and building that relationship with them on the ground. We were living in Boulder, Colorado, which is where we live now. And my other business partner was living in Boston, and we had to fly out there and learn the market and drive everything and know what was going on. We were like racing in the local 10K and visiting my family and, building a relationship with these bankers all the while. So it's old school, but it makes a difference. Would we be able to get an unsecured line of credit today in today's lending environment? Probably not. And here's another takeaway for folks that are getting into this. If you have a W-2 job that has solid income, and you're looking to get into investing on your own, where you're going to buy your own assets and you need to take out leverage in order to do that, hold your W-2 income and that safety that the banks feel really good about as you transition into this. Like, I would hold that literally, even if your job is like terrible, you don't like it anymore, keep it so that you can have that income that you can represent while you're applying for these different lending products, because it will make it so much easier. If we'd had our W-2 jobs and gone right into this, we would have been able to probably get that same kind of loan product. But we really had to do the whole dog and pony show about who we were and what we were doing because we had that gap in income. So that made it difficult for us. We're so lucky the environment was what it was, and banks were like very happy to deploy debt at that time. It's very much a different situation right now. Banks are nervous. The hawkish Federal Reserve is continuing to increase interest rates, and lending is getting more expensive, and they're being more careful about, debt service coverage ratios and loan to value. That stuff is much more, they're much more careful. They need that asset to collateralize the loan. You can't just get an unsecured line of credit without having something to back it up. So
sure. Yeah, it's true. I actually was just able to secure a $300,000 unsecured which I did end up ultimately collateralizing in order to not have to really go through any of the documentation process. It just simplified the process for me. The stuff is out there, but you've got to get a bit more creative about it. Much like you did in the beginning when you were starting off and going through a seller financing. There are those types of deals still around for folks that have found it difficult. And I couldn't be more on the same page with you about having your W-2 position really help you progress to a point through the transition versus just cold turkey quitting like you guys did, because it does make it a lot more complicated. Most of the time, as a lot of people probably already know, a 24-month history is usually going to be sort of a typical conventional requirement. And if you don't have at least 2 years of alternative income streams, you're going to have some challenges of being able to borrow.